again. And let's go with this chapter 3. What we're going to do now is once we prepare the journal entry, once we post it in the accounts, once we prepare the trial balance. Now let's see what's the next step. The next step, we're going to move to adjusting entries. Today we're going to start this journalizing the adjusting entries and preparing this adjusting trial balance. Now the question is, since we prepared this trial balance, why do we need to adjust it? Well, because we have to answer a few questions. Since we're focused on the revenue, now the owners of the company, they want to see income, right? And we already know the income comes from the revenue minus expenses. So what we have to answer, when the sales actually happen and when we can record the expenses. Because if I delay recording the expenses, my income is going to be higher. If I record the expense earlier, my income is going to be lower. Same thing with the sales. If I push the sales on the next period, current period, my sales will be lower. That means my net income will be lower. If I get the revenue, sales or revenue recognized this period, then I can manipulate the net income. So that's where we're going to focus now. So first thing first, time period assumption. Everything happens in our life because there's a time. If there's no time, nothing's going to happen. So for that reason, we're going to report the accounting information for the period of time. It is going to be monthly, it is going to be quarterly, it is going to be annual. We're never going to report financial statements or financial information on the weekly basis. So the shortest period available is month. Next one is quarter, half year, annual. Now, why do we need the time assumptions? Because that's going to affect our revenue and expense recognition. Where to recognize the revenue? On which period? Is it going to be in June? Is it going to be July? Is it going to be August? And then that's going to affect the income. So what we want to record the revenue in the correct period. And expenses related to the revenue also in the correct period when the revenue is recognized. So those two can match each other. So what is the accounting period? Every business have annual reports. So we're going to have a fiscal year, which fiscal year is not the same as a calendar year. In the businesses, when the companies start operating, we're going to see that the fiscal year is not the calendar year. Calendar year runs from January to 1st to December 31st, where the fiscal year can run any period. Company has a choice to choose where the fiscal year is going to start. Fiscal year is the reporting year for the company. So some company decide to choose July 31st to be year end. I was working in the company that July 31st was year end. Then I was working in the company, then September 30th is the year end. In another company, October 31st was the year end. Why is that? For different purposes. Mostly because of the nature of the business. So, and then we're going to have those interim statements with inter statements, which those are statements within the fiscal year, which can be monthly, quarterly, semi-annually. Again, we never prepare reports on the weekly basis. So when we're going to recognize, so now we have two events that happen in the company. I want you to understand this. We have two events that happen in the company. Recognition and realization. Realization means when the consideration is exchanged. Consideration means financial, what will be that? Financial resources are exchanged between one person to another person. Now, consideration can be cash, can be another services. But that will be when the realization happens. When the recognition happens, that's a different story. For example, all of you paid for the course before the event course started. Now, the exchange of the cash consideration was made. Douglas College receive your cash. You receive promise that you're going to get something in the future. Now, the question is, for what you paid for? You paid for the service. On the time that the consideration was exchanged, was the service provided to you? That will be the only question. When you pay for the course, did you receive the service? No. So the question is, can Douglas College recognize revenue at the time that they receive your money? Simple answer will be, we have to check. What we have to check? Did they earn the revenue? What means earn the revenue? Earn the revenue means they delivered the service or you received the goods. Or if there's a contract, all the agreement on the contractual agreements has been met. So the question is, yes, Douglas College received your cash. The next question is, can they recognize the revenue? Did they earn the revenue? Did they provide the service for you? To you. In this case, what you're going to say? Yes or no? No. In that case, did the Douglas College earn the revenue? No. Then what is the money that you paid Douglas College for Douglas College right now? Since they didn't provide the service, but they have your cash. What is that for them? Unearned revenue or liability. Both are correct. Both answers on the chat are correct. It's unearned revenue, which is treated as a liability. So when the recognition criteria for the revenue is going to be met? When to record the revenue and how much the amount of the revenue to record. This is what we have to do now. Now, end of the semester, that will be if we don't do accounting on the monthly basis. But if we do accounting on the monthly basis, imagine at the end of May, we have to prepare monthly statement. The question is, did the college receive your cash? Yes, clearly yes. For what period of time? For the whole semester. At the end of May, did the college provide service to you? At the end of May, did Douglas College provide service to you? In terms of lectures. Did you receive any lectures from the beginning of the semester to the end of May? Yes. For what period? For 1 month. How long is the whole semester? $4 months. So let's pretend you're paying 1,000, let's say how much? $800. You're paying $800 for the course for the whole semester. So then, how much is per month? $200. So at the end of the month of May, how much of those $800 Douglas College earn? How much they earn at the end of June? Make sense? Yeah, that will be another 200 if you look at month by month, right? If you look at both answers are correct because in month of May they earn 200, and only for month of June they are not on another 200. In total, they earn 400. How much is gonna stay on earned revenue? 400. Make sense? So at the end of May, so let's start with the beginning of the May. How much will be earned revenue for Douglas College out of $800? Beginning of May, 800. At the end of May, how much will be earned? How much will be earned? Excellent. Listen carefully. At the end of July, what will be the proportion? Earned versus unearned. Thank you. You're already accountant. So do you understand this? We're gonna record the revenue equal to the goods and services that we actually received, not for the goods and services that we paid for. How much cash we paid, it's irrelevant. It's relevant how much we received. So let's go with the recognition. Keep going with the recognition. Recognition criteria of the revenue is, again, we're going to have what will be that here? Let me see what says here. Thank you for the order. So, and the check, we will get advertisements ready. So this person going and purchase advertising. He pay for the advertising. He pays for the advertising. And but the advertising doesn't start until January 1st. So did the company have to record any revenue in this case? He paid for it. In this case, no. Why? Because nothing has been posted yet. On January 31st, when the advertisement actually was run for the entire month, how much of the revenue the company can recognize now? The whole amount. Make sense? So there are always going to be services which are based on the conditions. So the matching objective is, first, to match expenses. So how about the expenses now? We established the revenue. Revenue is always have to be earned or either services delivered, either goods received. How about the expenses? We have to match the expenses with the revenue. So if the revenue is delivered, the services is delivered from January 1st to January 31st, all the expenses related to that revenue have to match that revenue. So incurred with the revenue earned during the accounting period, and the match expenses incurred with the appropriate time period. So we have to match it with the revenue and with the appropriate time period. So let's keep going here. Now, the definition of the expenses. The definition of the expenses will be simply cost of the assets in terms of inventory, which we're going to sell to the customer, or the services which are consumed in order to earn the revenue. So for that reason, we're matching the revenue with the expenses, or expenses with the revenue. The magic objective is to help us to record the appropriate expenses into the appropriate period. So we're going to identify all the expenses during the period of accounting. We're going to measure the expenses, and we're going to match the expenses against the revenue earned during that period. Recognition criteria will be some expenses cannot be easily matched to the revenue. For example, rent and utilities. So for this type of expenses, they should be matched to the time period they are related to. So for example, watch this. Your utility bills for the electricity comes 2 months after, 1 month after the period ended. So if I'm paying my electricity bill and my electricity bill comes, so I'm paying for January and February, but the bill comes in March. So when the bill comes in March, is this expense for March or not? So what do I have to do? I have to recognize the expense earlier in January and February. So when the bill comes in March, that bill to relate to the January and February. How are we going to do that? That's another story, but I want you to get the idea now. So we have to match the expenses with the right period, even if we don't have the invoice yet. So let's see what we're going to do. We're going to distinguish now between accrual accounting and the cash accounting basis. So there are two ways to run the accounting. One basis is to cash basis. So what that means? We're going to always recognize the revenue when the cash is received, and we're always going to recognize the expenses when the cash is received. Who's doing that? Canada Revenue doing that. In accounting, we have to show the revenue in the right period when the service is received, not when the cash is paid. And we have to show the expenses in the right period when the expenses are related to the revenue, not when the expenses are paid. That's called accrual accounting. That's why you saw the journal entry is we receive equipment, we haven't paid for the equipment yet. So we're doing the accrual accounting means debit equipment, credit accounts payable. We provide the revenue, we haven't collected the cash. Debit accounts receivables, credit revenue. If it was cash accounting, will be we provided the services, the client hasn't paid. Nothing. The client, 3 months later, the client paid. Well, then cash, debit cash, credit revenue. Is that the right thing to do? Obviously not. Why? Because the service wasn't provided 3 months later, was to provide 3 months earlier. The fact that we didn't collect the cash, it doesn't change the fact that we provide the service. So for that reason, we're going to have these adjusting entries. Adjusting entries will be the difference between cash basis accounting and accrual basis accounting. In the accrual basis accounting, we try to match the revenue expenses in the right period, not when the cash is received. And accrual basis accounting is going to produce the correct financial statements, which are going to show us the revenue and expenses in the same period, and we can evaluate the company. Is the company generating income or not? And that's where I'm going to stop. And the remaining of the chapter, we're going to cover it next time in person. The whole idea here is in one type of accounts, expenses happen first and then is the payment. or the payment happen, the revenue happen first, and then it's the payment. In some transaction, payment happen first, and after that the expenses, or payment happen first, and then after that is the revenue. So that's what we have to do. That's what will determine which one is deferred, which one is accrued. You already know if you want to push something in the future, you defer it. If you're not ready for the exam, you're gonna defer the exam. If you want to get something faster, you're gonna accrue it. You're gonna get it earlier. And then you're gonna pay for it. That's what we're gonna practice for the remaining of the chapter. Thank you for today. Amazing job, guys. I'm so happy with this group. Keep the hard work, practice. You have enough information now for the text next time. Next time, we're going to see each other in class. Don't forget that. Room on view, 7th floor. Please be there. And in the meantime, enjoy the rest of your day. Have a great weekend. And again, we're going to see each other next week. Again, thank you for today.